international trade theories are simply different theories to explain international trade. Trade is the concept of exchanging goods and services between two peoples or entities, while international trade is then the concept of this exchange between peoples or entities in two different countries. People or entity trades because they believe that they will benefit from the exchange. They may need or want the goods or services. While at the surface, this may sound very simple because there's a great deal of theory, policy, and there's a business strategy that will constitute international trades. Moreover, trade theories have evolved over the past century and which are most relevant today. Around 5,200 years ago in Europe, which is in southern of Mesopotamia, was probably the first city in the world that have ever seen, housing more than 50,000 people within its 6 miles of wall. Europe is an agriculture made prosperous by its sophisticated irrigation canals, was home to the first class of middlemen, trade intermediaries with a cooperative trade network. Hence, they set the pattern that would endure for the next 6,000 years. To better understand how modern global trade has evolved, it's important to understand how countries trade with one another historically. Over time, economists have developed theories to explain the mechanism of global trade. The main historical theories are called classical and are from the perspective of a country or country base. Then by the middle 20th century, the theories began to shift to explain trade from a firm rather than a country perspective. So these theories are referred to as modern and are firm-based or company-based. Both of these categories, classical and modern, consist of several international theories. First, we will talk about the international theory, which consists in the classical country-based theories, which is mercantilism, absolute and comparative advantage, and texture all in. Developed in the 16th century, mercantilism was one of the earliest efforts to develop an economic theory. This theory stated that a country's wealth was determined by the amount of its gold and silver holdings. In a simple sense, mercantilists believed that a country should increase its holding of gold and silver by promoting export and discouraging imports. In other words, if people in other countries buy more from you than they sell to you, then they will have to pay you the difference in the gold and silver. The objective of each country was to have a trade surplus or a situation where the value of export are greater than the value of imports, and to avoid a trade deficit or a situation where the value of imports is greater than the value of export. Although mercantilism is one of the oldest trade theories, it remains part of modern thinking. Countries such as Japan, China, Singapore, Taiwan, and even Germany still favor export and discourage import through a form of neo-mercantilism in which the country promote a combination of protectionist policies and restriction and domestic industry subsidies. After that, in 1766, Adam Smith questioned the leading mercantile theory of the time in The Wealth of Nations. Smith then offered a new trade theory called absolute advantage, which focused on the ability of a country to produce a good more efficiently than other nations. Smith reasoned that trade between countries shouldn't be regulated or restricted by government policy or intervention. He stated that trade should flow naturally according to market force in a hypothetical two-country world. If country A could produce a goods cheaper or faster, or both than country B, then country A had the advantage and could focus on specializing on producing that goods. By specialization, countries would generate efficiencies because their labor force would become more skilled by doing same tasks. Production will also become more efficient because there will be an incentive to create faster and better production methods to increase their specialization. The challenge to the absolute advantage theory was some countries may be better at producing both goods and therefore have an advantage in many areas. In contrast, another country may not have any useful absolute advantage. To answer this challenge, David Ricardo, an English economist, introduced the theory of comparative advantage in 1817. Ricardo reasoned that even if country A had the absolute advantage in the production of both products, specialization and trade could still occur between two countries. So comparative advantage occurs when a country cannot produce a product more efficiently than other country. However, it can produce that product better and more efficiently than it does other goods. The difference between these two theories is subtle. Comparative advantage focuses on the relative productivity differences, whereas absolute advantage looks at the absolute productivity. Lastly is the Hector-Orlin theory or factors proportion theory, The theories of Smith and Ricardo didn't help country determine which products to give a country an advantage. Both theories assume that free and open markets would lead country and producer to determine which goods they could produce more efficiently. In the early of 19th, two Swedish economy, Elie Heckscher and Bertil Ohlins, focused their attention on how a country could gain comparative advantage by producing products that utilize factors that were in abundance in the country. Their theory is based on a country's production factors, which is land, labor, and capital, which will provide the funds for investment in plants and equipment. They determine that the cost of any factor or resources was a function of supply and demand. Factors that were in great supply relative to demand would be cheaper, while factor in great demand relative to supply would be more expensive. So based on their theory, it stated that countries would produce and export goods that require resources or factors that were in great supply and therefore cheaper production factor. In contrast, countries would import goods that require resources that were in short supply but high demand. For example, China and India are home to cheap, large pool of labor. Hence, these countries have become the optimal location for labor-intensive industry such as textile and garments. However, in the modern firm-based theories, they have different perspectives on international theory, which can be concise as country similarity, product life cycle, global strategic rivalry, and Porter's national competitive advantage. The category of modern firm-based theories emerged after the World War II and was developed in a large part of business school professors but not economists. Unlike the country-based theories, firm-based theories incorporated other products and services factors, including the brand and customer loyalty, technology, and quality, into the understanding of trade flows. This counter-similarity theory was developed by Swedish economist Stefan Linder in 1961 as he tried to explain the concept of intra-industry trade. Linder's theory proposed that consumers in countries that are in the same or similar stage of development would have similar preference. In this firm-based theory, Linder suggested that companies first produce for domestic consumption. When they explore exporting, the companies often find that markets that look similar to their domestic one in terms of customer preference offers the most potential for success. Linder's country similarity theory then states that most trade in manufactured goods will be between countries with similar per capita incomes, and intra-industry trade will make the common. This theory is often most useful in understanding trade in goods, where brand names and product reputation are important factors in the buyer decision-making and purchasing processes. Following that, product life cycle theory was developed by Raymond Vernon, which is a Harvard Business School professor in 1960s, which also can be defined as theory that originating in the field of marketing. This theory states that a product life cycle has three distinct stages, which is new product stages, maturing product stages, and standardized product stages. The theory assumed that production of the new product will occur completely in the home country of its innovation. In the 1960s, this was a useful theory to explain the manufacturing success of United States. US manufacturing was the globe dominant producer in many industries after World War II. The product life cycle theory has been less able to explain current trade patterns where innovation and manufacturing occurs around the world. For example, global companies even conduct research and development in developing markets where highly skilled labor and facilities are usually cheaper. Global strategic rivalry theory emerged in the 1980s and were based on the work of economists Paul Krugman and Kelvin Lanchester. Their theory focused on MNCs and their efforts to gain a competitive advantage against other global firms in the industry. Firms will encounter global competition in the industry, and in order to prosper, they must develop competitive advantage. The critical ways that firms can obtain a sustainable competitive advantage are called the barriers to entry for the industry. The barriers to entry refer to obstacles a new firm may face when trying to enter into an industry or new market. The barriers to entry that corporations may seek to optimize include the research and development, ownership of intellectual property rights, economy of scale, uniqueness, business processes, and the control of resources or favorable access to raw material. In the continuing evolution of international trade theories, Michael Porter of Harvard Business School developed a new model to explain national competitive advantage in 1990s. Porter theory states that a nation's competitiveness in an industry depends on the capacity of the industry to innovate and upgrade. His theory focuses on explaining why some nations are more competitive in certain industry. To explain his theory, Porto identified 4 determinants that he linked together. The 4 determinants are local market resources and capabilities, local market demand condition, local supplier and complementary industries, and local firm characteristic. In addition to the 4 determinants of the diamond, Porters also note that government and chance plays a part in the national competitiveness of industry. Government can, by their action and policies, increase the competitiveness of firms and occasionally entire business.
I will continue discuss the international trade and the economy. Through international trade in activities, Malaysia can sell its product and service to other countries and earn foreign exchange earning, which help us develop and expand our economy. Also, Malaysia is able to buy goods and service it requires from other countries. International or world market present huge opportunity for Malaysian manufacturers and traders to sell products and service. As again to the domestic market, which is relatively very small. So now I will be discuss about the balance of trade BOT and the balance of payment BOP. The BOT is the difference between the total value of export and the total value of import. Positive BOT occurs when the total value of export exceeds the total value of import. So BOT is a gross earning on a country out of its international trade. Next, the BOP is the net earning of a country after accounting for the movement of capital out of that country. The reason a lot of money move away from Malaysia to other countries is some of them include repayment of foreign debts, increase in investment overseas, and remittance of money to overseas by our people and foreign workers. The positive BOP will increase the international receipt. There are some benefits of international trade to the 3 main parties. So what are the 3 main parties? It was the consumer, producer, and also country. First, to the consumer, fulfill the consumer needs and wants, meet the consumer expectation with various choice. Besides, the benefit is to provide the job opportunity and also provide the different quality and cost of the product and service. Second, to the producer. So the benefits of international trade is increase the market size and increase the quantity and quality of production, and also exchange information and technology with other countries to increase the production. More raw material are available and competitive to push the producer to get the new technology. And the next party is the country. Enhance country economy status, improve the relationship between the other countries that have the business, and increase the earning in foreign exchange and reduce the unemployment rate, and everyone can get a job and increase the life quality. And the last one is obtain the raw material and expective.
Good morning to sir. I'm Hokaisi 271940. I'm going to present topic 1, Introduction to International Trade, about the parties involved in international trade. The first party involved in international trade is exporter, which also called seller, beneficiary, and drawer. Exporter is a wholesaler who sells to merchants or industrial consumers in foreign countries. The second party involved in international trade is importer, which also calls applicants and drawee. Importers is a person who import things, goods into their country. The last party involved in international trade is bank, which also called intermediaries for exporter and importer. Bank is a financial institution's license to provide trade financing for international trades such as letter of credit, bank acceptance, and others. In international trade, importer and exporter sign the sales contract in an agreed terms. In fact, exporter expected to get the payment immediately before exports the goods without worrying the risk of default. Importer expected the goods from exporter for his payment. Actually, ideally, importer want to make sure they obtain the correct quality and specifications of goods before he pays. Bank as intermediaries for importer and exporter to help them in trade financing, handle shipping documents under letter of credits and collections, as well as payment. Bank as being documents processes in international trade. Let us look about the type of exchange involved in international trade. In exchange of goods, exporter will send the goods to importer. In exchange of documents, exporter send the trade documents to bank, and then bank send it to importers, or exporter will just directly send the trade documents to importer. Lastly, in exchange of payment, importers pay the payment to bank, and then bank will send the payment to exporter.
So after that, we will talk about the challenge which will happen in international trade. Challenge which might happen in international trade is culture challenge. Why do we say so? It's because different country has different culture. So the needs of good will also vary among two countries. In a business context, cultures relate to what behavior is common and accepted professionally in one location compared to another. What may be acceptable business practice in one country may be very different from the approach that used by the business in another country. Therefore, recognizing how culture can affect international business is something that should be understood in order to avoid misunderstandings between colleagues and their clients, and also to make sure that business are presenting themselves to their new markets in the best way they can. Next is the economic status. The stability of economic status in a country will affect the global trading. For instance, the appearance of inflation, hence the fluctuation of goods will reflect the demand and supply of goods from one country to another. Another challenge for international trade is standardization. Different countries have different rules and regulations that they have to comply before any transaction of goods can be done between two companies in different countries. After that, measurement is also one of the challenge in international trade because different countries approach with different of measurement in trading, such as imperial units, miles, feet, and meter. Furthermore, the payment method for every transaction might vary between two parties enter into the agreement. So the selection of methods of payment should be mutually agreed by both parties during their business negotiation. Lastly, custom rules and practices is the challenge. Custom rules and procedure is the challenge that might happen in international trade because strict rules and procedure may cause some of the goods cannot be accepted in the custom.
Good day to topic sharer. I'm YONG, number metric 270617. I will be presenting the risks that might encounter during the international trade business, and I will come up with a few solutions that can mitigate the risk. First of all, is the different types of risk in international trade business. Businesses engaged in global trade have to deal with not only their local business risks, but also a number of global business development risks. These are the major barriers that resist the growth for business. These risks have obstructed the smooth running of the business, hence appropriate measures need to be taken to limit their effects. Here are 4 risks commonly faced by businesses involved in international trade, which are credit risk, foreign exchange risk, cargo risk, country and political risk. Firstly, credit risk. Credit risk is the risk that might arise due to inability of the buyer to pay on the due date. Credit risk is not the same as one sells the goods in domestic market and in foreign market. Success in international business depends on the ability of the exporter to give credits to importers on a competitive and favorable terms. Export business has become highly risky as selling on credit has become very common. This is because there are many exporters competing for the cake of international trade. Therefore, offering credit has become unavoidable to exporters to face competition. Secondly, foreign exchange risk. It occurs when the value of an investment fluctuates due to the change in a currency exchange rate. When the exchange rate volatile, the return earned will decrease after being exchanged back in the domestic currency. If exporter has invoiced in the buyer's currency, he will be subjected to risk of foreign exchange fluctuation. If the foreign currency depreciates in terms of ringgit, exporter will receive lesser amount in terms of ringgit. Thirdly, cargo risk. Transportation of cargo has undergone radical improvements over a period. Most of the goods are transported by sea. Transit risks are a common hazard for those engaged in import and export business. There is no guarantee that consumers will get the goods in time and with good condition. There are risks that might cause hazard loss in transportation. For example, storm, collision, theft, explosion, fire, and sea robbery. The International Chamber of Commerce (Intercoms) has set out each party roles and responsibilities with regards to shipping risk. It is best to work with a forwarding agent. Lastly, country and political risk. Political risk is generally defined as the risk to business interests resulting from political instability or political change. Political risk exists in every country around the globe and varies in magnitude and type from country to country. Political risk may arise from policy change by governments to change control imposed on exchange rates and interest rate. Moreover, political risk may be caused by action of legitimate government such as control on price, outputs, activity, currency, and remittance restrictions. The purpose of risk management is not to eliminate all risk, but is to minimize the potential negative consequences of risk. Letter of credit. It is a letter that contingent payment commitment issued by a financial institution, whereby the financial institution agrees to pay a set of amount to the product or service provider in exchange for the delivery within a set time frame of document proving that the goods were shipped. Letter of credit protects both the buyers and the seller. It includes the terms of sales and a detailed description of the shipment. The funds were set aside and cannot be used by the buyer as long as the letter is enforced. Exporter will no longer expose under the credit risk in international trade, as letter of credit has minimized the risk for exporter. Secondly, insurance. Shipping goods abroad or locally, you may face issues such as contamination, seizure, accident, vandalism, theft, loss, and breakage. Before shipping any goods to the buyers, exporters need to make sure to have sufficient insurance. Marine insurance provides an important way to manage the risk of importing and exporting, providing protection for both the supplier and purchaser. It helps safeguard against damage incurred in transit, whether by sea or air. It is effective in reducing the cargo risk. Thirdly, get advice from locals. The simplest way to mitigate political risk is to research the readiness of the country before conducting business abroad. It can be done either by paying the reports from consultants that specialize in making this assessment or doing research ourselves through many different free sources available on the internet. We can even work closely with the local institution and get advice from institutions like NATRIC. Then we will have more informed option to not set up operation in countries considered political risk hotspot. Meanwhile, companies can sometimes negotiate terms of compensation with the host country. So there would be a legal basis for resource if something happens to disrupt the company's operation. Lastly, forward exchange contract. A forward exchange contract is an agreement under which a business agrees to buy a certain amount of foreign currency on a specific future date. The purchase is made at a predetermined exchange rate. By entering into this contract, the buyer can protect itself from subsequent fluctuation in foreign currency exchange rate. The intent of this contract is to hedge a foreign exchange position in order to avoid a loss or to speculate a future change in exchange rate in order to generate a gain.
I'm going to present about the role of banks in international trade. Banks play main roles in financing of trade for both exporters and importers in international trade and finance. There are many services provided by banks to their customers. Firstly, banks give trade information and provide replies to status inquiries. Bank will suggest the best trade financing to customer after realize the trade information and reply the request from customer asking the bank to give confidential opinion on financing. Secondly, bank as being document processors. They are responsible to receive, process, and file trade documents on behalf of exporter or importer. For instance, bank as intermediary for importer and exporter to handle shipping documents under letter of credit, collections, and payments. Thirdly, bank obtain the payment from the importer and remitting the sum obtained. For instance, documentary against payment, the remitting bank advise and credit the exporter account upon receipt of the proceeds of the collecting bank. Fourthly, provide finance. Bank will give some financing arrangements to importer who seek help for financing, as well as provide some trade financing facilities such as letter of credit, trust receipt, bank acceptance, and others. Fifthly, bank give advice about the type of risk involved. Before make decisions of trade financing, bank will explain some risks related to the type of trade financing, such as credit risk, foreign exchange risk, shipping risk, and others, to make sure the customer take a best trade financing for their international trade. Lastly, bank also supply foreign exchange currency and provide tools to hedge foreign currency fluctuation. Let us talk about the role of bank in Malaysia in international trade. Firstly, to facilitate the export of goods and services from Malaysia by means of export credit, finance for capital investment, and business information and advisory service. Secondly, to enable Malaysian exporters to compete in overseas market on an equal footing with their competitors from other countries. Thirdly, to facilitate the diversification and augmentations of the export market basket of Malaysia with emphasis on the export of capital goods. They are some of the trade financing facilities offered by commercial banks and Export-Import Bank of Malaysia. Firstly, banker acceptance. Banker acceptance is a bill of exchange that can be requested by customer from the bank to obtain financing for imports and exports to ensure payment. Secondly, bank guarantee. Bank guarantee is a legal undertaking in writing issued by a bank on behalf of a customer to a third party, which is beneficiary for the purpose of guaranteeing payments of a certain amount of money in the event of the customer failing to settle the debt or for non-performance by the customer of a legal obligation. Thirdly, bilateral payment agreement. Bilateral payment agreements is a mechanism for the settlement of net monetary obligations arising from trades between two countries, and the purpose is to promote trade between Malaysia and other designated developing countries. Fourthly, export bill purchase or discounted. The export bill purchase is a kind of short-term financing where customers sell the full set of export documents, which will in turn pay customer the face value minus the interest, as well as any charge incurred during the dates of purchase to predicted dates of receiving payment. Export credit refinancing, also one of the trade financings in international trade. Export credit refinancing provide an alternative short-term pre- and post-shipment financing to direct or indirect exporters to promote export of manufactured product and primary commodities and others that are halal through the provisions of Sharia compliance financing facilities. Furthermore, letter of credit. Letter of credit is the guarantee by a bank that they will pay the seller or exporter in the event of the buyer or importer becomes insolvent. In addition, export credit insurance. Export credit insurance is a type of trade credit insurance tailor-made especially for exporter of goods and raw materials. Moreover, buyer credit guarantee. Buyer credit guarantees is a security to the lender in case of a credit risk caused by a foreign buyer, the foreign bank or country. Besides, bank letter of credit policy. A bank letter of credit policy is a guarantee by bank that a buyer in a foreign transactions will be paid. Lastly, foreign currency trade financing. Foreign currency trade financing is a foreign currency financing instrument to finance trade translations denominated in foreign countries or ringgit. That's all for trade financing facility. Thank you.
Good day, Dr. Shahril and Lim Wan Yu 271484. Now I will present about the assistance provided by government agency in facilitating international trade. One of the agency is MATRAD. MATRAD is a national export promotion agency in Malaysia which is in charge to help Malaysian companies succeed in the international market. The vision of MATRAD is to make Malaysia as a worldwide competitive trading country, while its mission is to develop and promote Malaysians' export and enterprise to the world. The first objective of MATRAD is to grow Malaysian exporter profile in foreign market. For example, MATRAD helped to introduce Malaysian company to foreign importer who seeking for supplier from Malaysia. Besides, it also distributes timely and relevant information and market intelligence to assist Malaysian companies achieve a competitive edge in foreign market. It also conducts activity to promote the export of Malaysian goods and services in overseas markets. There are several assistance provided by MATRAD. First, Brand Promotion Grant (BPG). The objective of BPG is to develop and promote brand names of products and services originating from Malaysia, which owned by Malaysian company in the international market. Second, Services Export Fund (SEF). SEF offers assistance to Malaysian service providers to carry out activity in order to expand into international market. Third, Market Development Grant (MDG). This scheme is intended to provide a matching grant to help SME to conduct promotion activity for export market development. Besides MATRAD, Exim Bank also play an important role in facilitating international trade growth. Exim Bank aims to accelerate worldwide business. It also provides effective financing and takaful solutions for cross-border projects. Exim Bank provides credit facility to finance and support export and import of goods, services, and overseas projects, especially for non-traditional markets. It also provides export credit insurance services, export financing insurance, overseas investment insurance, and guarantee facility. Not only that, Ministry in Malaysia also provide business support, advisory services, and financial assistance to help international trade growth. Some of the ministry are MOF, MOHR, MOSTI, MOT, and MOHE. They provide assistance in the area of technology development, tax incentive, grants, guarantee scheme, equity financing, marketing and promotion, product development and accreditation, as well as upgrade the workforce skill. Other agencies and organizations such as MIDA, MARA, and SMIDEC also offer assistance to ease international trade. MIDA is the principal agency for the promotion of the manufacturing and services sector in Malaysia. Besides, MARA is responsible for developing, encouraging, facilitating, and fostering the economic and social development in the Federation, particularly in rural areas, while SMIDEC aims to develop capable and resilient Malaysian small and medium industry to be competitive in the international market. Next, I will present about the digitalization in trade. Nowadays, digitalization has made the operation of trading activity either locally or internationally become easier. The digital transformation has reduced the cost in conducting international trade, generate use of technology in trading activities, and enhance the business capacity. Digital trade enables transaction of goods and services can be conducted digitally and physically. For example, consumer can purchase the goods digitally, which is through online platform, while the delivery of goods can be delivered physically. The size, range, and speed of trade also improved by digitalization. It helps companies to bring new goods and services to a greater range of digital-related consumers around the world. It also encourages companies, especially small and medium-sized, to take advantage of modern and creative digital technology to overcome obstacles, to help facilitate payment, to enable cooperation among countries through the use of cloud-based platforms. Furthermore, Malaysia Digital Economic Corporation organized strategic national initiative, which is Digital Free Trade Zone (DFTZ) to foster efficient cross-border trade through digitalization and to encourage local SME access to large opportunities through e-commerce in global market. DFTZ will provide physical and virtual zones to facilitate SME to capitalize on the convergence of rapid growth of the internet economy and cross-border e-commerce activity. DFTZ aims to help SME to export their product internationally easily. It enables global marketplace to source from Malaysian manufacturer or seller. It also makes Malaysia a regional fulfillment hub for global brands to reach Asian buyers. It also fosters ecosystems to drive innovation in e-commerce and internet economy. There are three components comprising both physical and virtual zones. First, e-fulfillment hub can help SME business in exporting their goods easily with the support of leading fulfillment service provider. Second, satellite services hub join SME or business with leading players who offer services like financing, last mile fulfillment, insurance, and other services which are important in international trade. Lastly, e-services platform can manage cargo clearance and other processes needed for global trade efficiently. That's all from me. Thank you.